The chair is authorized to declare recess of the committee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is entitled Examining Federal Reserve Reform Proposals. I now recognize myself for 5 minutes to give an opening statement. Some see the last decade of monetary policy as a failure, while others see it as a success. Wherever we stand on this debate, I hope we can all agree that stronger economic growth over recent quarters is promising, and American economic opportunities can expand even faster with reforms that build on the best ideas from both sides of our aisle. The legislation we will consider today does just that. Monetary policy can appear complicated, but whether you work in the Fed's Eccles building or in any of our districts, monetary policy supports a stronger economy when it is communicated simply and clearly. Recent Fed research finds that uncertainty about monetary policy slows our economy and reduces credit availability. In other words, simple and clear policy communications improve American economic opportunities. Both Democratic and Republican witnesses have testified before us on the importance of a simple and clear communication of monetary policy. For example, during our last Humphrey Hawkins hearing, Federal Reserve Board Chair Yellen expressed interest in working with our committee to codify a simple and effective strategy for a more transparent monetary policy. In addition, former Vice Chair of the Federal Reserve Board, Dr. Donald Cohn, offered the following advice in a recent Brookings Institution report. The Federal Reserve should use the semi-annual monetary policy report to better explain and focus on its broad strategy. For some time, the Fed's Open Market Committee has been shown the results of a number of policy rules, and this material has been accompanied by explanations of why the current and expected settings of monetary policy might deviate from the rules. The Monetary Policy Transparency and Accountability Act that we will consider today provides for exactly this type of framework. Indeed, this bill reflects the very generous advice of both Chair Yellen and Dr. Cohn. Our draft legislation also addresses what members of Congress and experts from both sides of the aisle see as an opportunity to better manage our fiscal house and increase our financial resiliency by protecting households from bailouts and holding Congress to account for tough decisions that can easily be punted to the Fed. Our Congressional Accountability for Emergency Lending Act takes an important step in this direction by embracing this bipartisan Warren-Vitter framework for congressional approval of emergency lending. At the same time, our Independence from Credit Policy Act maintains the Fed's role as an originator of emergency loans while insulating our monetary authority from compromising political pressures to overreach into credit policy. Authoritative economists of different stripes share a common concern about these pressures. Testifying as a witness for my Democratic friends, MIT professor Simon Johnson emphasized this bipartisan agreement. I think we're all agreeing that this fiscal policy infrastructure is the responsibility of the fiscal authority, which is that of the Congress in the United States acting through the executive branch. It is not the responsibility and should not become the responsibility of the Federal Reserve. Recently, Brandeis professor Stephen Cicchetti shared the same concern as a minority witness for our joint FI-MPT subcommittee hearing. And even the New York Times' Paul Krugman joined this chorus, highlighting how the Fed's unconventional balance sheet blurs the lines between monetary and fiscal policies. Acknowledging such concerns during our last Humphrey Hawkins hearing, Federal Reserve Board Chair Janet Yellen committed the FOMC to reestablishing a bright line between monetary and credit policy. She said, "The FOMC has clearly indicated that it intends to return over time to a primarily Treasury-only portfolio, and that's in order not to influence the allocation of credit in the economy." Coupled with our Congressional Accountability for Emergency Lending Act, the Independence from Credit Policy Act does precisely what Chair Yellen has advocated: a return to a primarily Treasury-only portfolio while maintaining the Fed's role as an originator of emergency loans. Greater transparency, independence, and accountability for monetary policy, coupled with greater fiscal accountability for Congress, that is a solid bipartisan recipe for what we all want, and that is greater economic opportunity for all Americans. I look forward to our witnesses' testimony and working with my friends on both sides of the aisle to realize the considerable benefits that this legislative package will deliver to each of our diverse constituents. The chair now recognizes the ranking member of the subcommittee, the gentlelady from Wisconsin, Gwen Moore, for 3 minutes for an opening statement.
Thank you so much, Mr. Chairman, and I want to thank our witnesses for coming in today. I look forward to your testimony. As for the bills we're considering, on one hand, I think that they're better than the other audit the Fed bills we've seen. But overall, they seem like problems foisted onto a functioning system. I'm glad that the majority has abandoned the so-called Taylor rule, but a watered-down Taylor rule is probably as unworkable if the Taylor rule is flawed. On the 13.3 authority, I have my own questions about it, but I've spent some time with the Fed understanding the importance of 13.3. Dodd-Frank made about the right amount of reforms to the Fed in this regard, and I sure hope that the new Fed chair would really sit down with Chair Yellen and really let her explain the benefits that 13.3 has had. At this point, I think the one thing that frightens me the most, and I would appreciate more clarity from this panel on, is the restriction of what the Fed holds, this Treasury-only schemata. It seems to me that this would be very problematic. This would have been problematic had it been in place during our crisis. So like I said, I don't see the problem that these bills are designed to solve, but I can see plenty of problems this legislation might cause. I would like to yield the rest of my time to Mr. Sherman.
The Fed should be restructured in part because it's so highly undemocratic. It is the only governmental institution where at least some of the leaders are selected by the notion one bank, one vote. All Fed governors at all levels should be presidential appointees. Second, it is undemocratic because the California Bank does not have a permanent seat on the Fed committee, whereas the New York Bank does, whereas far more people live in the California region. The allocation of seats should reflect population, not political power. If there's been a failure of Fed policy, it's because they were too timid with quantitative easing. And now they are too hawkish when it comes to raising the interest rate. Our inflation rate is not only below their target, it's below the target they should have, which would be closer to 2.5%. We continue to have low wages. What Americans demand is the kind of labor shortage that will cause much faster growing wages. That cannot be achieved with the Fed's current timid policy of caving in to those who, just pretty much for historical reasons, believe we should have higher interest rates and abolish quantitative easing. Finally, it is only because Fed policy is the domain of people who live in the Fed world that we ignore the $75 to $100 billion the Fed has been able to transfer to the U.S. Treasury. In my district, that's real money. And yet it doesn't get we pay far more attention on the cost of building one bridge in Alaska than we have in $75 to $100 billion transferred to the U.S. Treasury for several years in a row, because nobody pays attention to the Fed except the Fed community, and the Fed community is embarrassed by its profit. I yield back.
The gentlelady's time has expired. The gentlelady yield back?
I yield back.
Gentlelady yields back. At this time, we'd like to welcome the testimony of our witnesses. First, Dr. Mickey Levy, the Chief Economist for the Americas and Asia at Berenberg Capital Markets. He conducts research on a variety of U.S. and global economic and macroeconomic topics and is an advisor to several Federal Reserve banks, including the Federal Reserve Bank of New York. Prior to his current position, Dr. Levy was Chief Economist at Bank of America and Blenheim Capital Management. He also has been an analyst at both the Congressional Budget Office and the American Enterprise Institute. Since 1983, he has served as a member of the Shadow Open Market Committee. Dr. Andrew Levin, a professor of economics at Dartmouth College, He was an economist at the Federal Reserve Board for 2 decades, including 2 years as a special advisor to Chairman Bernanke, and then Vice Chair Yellen on monetary policy strategy and communications. He subsequently served as an advisor at the International Monetary Fund. Professor Levin is currently an external advisor to the Bank of Korea and a regular scholar at the Bank of Canada. He has also served as a consultant to the European Central Bank and as a visiting scholar at the Bank of Japan and the Dutch National Bank. And he has provided technical assistance to the national banks of Albania, Argentina, Ghana, Macedonia, and Ukraine. He received his PhD in economics from Stanford University in 1989. Jared Bernstein is the senior fellow at the Center on Budget and Policy Priorities. From 2009 to 2011, Bernstein was the chief economist and economic advisor to Vice President Joe Biden, executive director of the White House Task Force on the Middle Class, and a member of President Obama's economic team. Bernstein's areas of expertise include federal and state economic and fiscal policies, income inequality and mobility, trends in employment and earnings, international comparisons, and the analysis of financial and housing markets. Prior to joining the Obama administration, Bernstein was a senior economist and the director of the Living Standards Program at the Economic Policy Institute in Washington, D.C. Between 1995 and 1996, he held the post of deputy chief economist at the U.S. Department of Labor. Bernstein holds a PhD in social welfare from Columbia University. Finally, Dr. Charles Plosser is a visiting fellow at the Hoover Institution at Stanford University. Plosser served as the president and CEO of the Federal Reserve Bank of Philadelphia from 2006 until his retirement in 2015. In his position, he served as a member of the Federal Open Market Committee. Prior to joining the Federal Reserve, Plosser was the John M. Olin Distinguished Professor of Economics and Public Policy and director of the Bradley Policy Research Center at the University of Rochester's William E. Simon Graduate School of Business Administration, where he served as dean from 1993 to 2003. In 2004, he was a visiting scholar at the Bank of England. Since January 2016, Plosser has served as a public governor for FINRA, where he serves on the Investment Committee and the Finance, Operations, and Technology Committee. Plosser earned his PhD and MBA degrees from the University of Chicago. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Dr. Plosser, we'll start with you. You are now recognized for 5 minutes. And if you could just push the button to turn on your microphone.
Technologically challenged at times.
Thank you, sir.
Chair Barr and members of the committee, thank you very much for the opportunity to share some thoughts with you today on the Federal Reserve. I've been talking about the Federal Reserve for the last 20 years at various times, and so I've given a lot of thought to many of its issues. It is simplified but helpful to think of Fed actions in terms of its balance sheet. The liabilities predominantly currency, and the reserves of the banking system. Increasing the liabilities is typically associated with monetary policy. However, the Fed can also manage the asset side of its balance sheet. Changes in composition of those assets are typically referred to as credit policy. Historically, the Fed has conducted monetary policy through the purchase or sale of Treasury securities. Indeed, the vast bulk of the Federal Reserve assets have been U.S. Treasuries since the modern Fed began in the 1950s. Credit policy simply did not play a role. Moreover, for most of the post-World War II era, the Fed's portfolio of treasuries was purposefully designed to be neutral vis-a-vis the private sector. It only held treasuries, and the distribution among bills, notes, and bonds was managed to roughly match the distribution of the treasury's issuances. In other words, it was felt that the Fed's portfolio should not try to alter the relative prices determined in the marketplace. Now, during the financial crisis and subsequent recession, the Fed altered both the size and composition of its balance sheet. In early 2008, the Fed sold treasuries to fund the purchase of approximately $30 billion of mostly private sector high-risk assets to support the acquisition of Bear Stearns by J.P. Morgan. Credit was also extended through various other lending programs that targeted specific industries, asset classes, and creditors. Now, whether you consider these as justified because of the crisis or not, they were, in effect, debt-financed fiscal policy without explicit authorization of Congress. Now, given the distributional effects of such interventions, it's not surprising they became somewhat controversial. Another major form of credit policy was the result of quantitative easing. QE was unconventional, but it was also unprecedented in that a significant portion of the assets purchased were in the form of mortgage-backed securities, not U.S. Treasuries. This action was explicitly intended to provide credit support for the housing sector. So why should the Fed have the authority to allocate credit within the economy in support of one industry, one company, or one individual? What are the risks and dangers of such a framework? The major risk is that it invites political interference and undermines the integrity of fiscal policy. History suggests that central banks that remain independent of the political environment and the fiscal authorities do better at controlling both inflation and promoting economic stability. Do we really want the Fed being lobbied by Congress or the public to manage the assets on its balance sheet to promote various political or fiscal agendas? The current trends, I believe, are not encouraging. For example, some members of Congress approached the Fed to lend money to the automobile companies in 2008. In 2010, Congress required the Fed to fund a federal agency over which it had no authority. And in 2015, Congress funded part of a transportation bill off the Fed's balance sheet. I believe these actions are bad policy. They undermine the independence of our central bank monetary policy making by confusing the roles and responsibilities of monetary and fiscal policy. Fed independence is fragile, and it's eroding. The Fed itself is contributing to this erosion of independence by engaging in off-budget fiscal policy through credit allocations. A policy that restricts the Fed to own only treasuries would go a long way towards limiting the Fed's ability to engage in credit allocation and limit the potential for abuse, or political abuse in particular, of its balance sheet. It would also help maintain a clear distinction between the role of the Fed and the role of the fiscal authorities, and thus help protect it from political interference. Some say an all-treasuries portfolio is dangerous and would limit the Fed's ability to respond in a fiscal crisis. But since 2009, I've been arguing that there's a better way. And it's to recognize and clarify who has the decision rights when it comes to fiscal decisions and who should be held accountable. The idea is to make clear that such emergencies it's the fiscal authorities that have the power and the authority to conduct fiscal actions, who should own both the decision rights and the accountability. The role of the Fed should be limited to helping the government execute those policies, but the Fed would be responsible for the Treasury would be responsible for making the decision. The Treasury would then be responsible for obtaining approval of Congress for the interventions, and then required to swap treasuries for non-treasury securities acquired by the Fed, thus restoring the all-treasury character of the Fed's balance sheet. This Fed-Treasury accord would enable emergencies to be addressed in a timely manner while protecting the integrity, accountability of fiscal policy decision-making.
The gentleman's time has expired, and we look forward to continuing this discussion in the Q&A. So we will now have to move on to Dr. Levin. You are recognized for 5 minutes for your opening statement.
Chairman Barr, Ranking Member Moore, and members of the Subcommittee on Monetary Policy and Trade, thank you for inviting me to testify at this hearing. The Federal Reserve is America's central bank. Its monetary policy decisions affect every American. Given the Fed's crucial role, it's important to ask, to whom is the Federal Reserve accountable? Who is the Fed's boss? Of course, the answer is Congress. The Fed reports directly to Congress, not to the president or anyone else. Now, I've intentionally used the term boss because we can draw on basic management principles to shed light on the issues being considered here today. Turning to Exhibit 1, there you go, hopefully get Exhibit 1. Here are 3 principles that are followed by every well-run business or nonprofit organization. 1, the boss must stay well-informed about the employee's strategy. Those consultations take place in annual reviews and occasional status updates, which are essential for maintaining accountability and avoiding micromanagement. After all, an employee can't be productive if the boss is constantly second-guessing their decisions. And that's the basic rationale for preserving the Fed's operational independence but requiring the Fed to explain its policy strategy in terms of simple benchmarks, which I'll return to in a moment. 2, extraordinary budget items require prompt approval. An employee should have authority to incur routine expenses, but the boss has to approve extraordinary items. And that principle is the essential rationale for preserving the Fed's operational independence, again, but establishing procedures to facilitate prompt congressional approval for its emergency lending facilities. 3, extraneous tasks should be reassigned elsewhere. Effective delegation requires a clear delineation of responsibilities. If a work assignment evolves into a task that doesn't fit within the employee's job description, then the boss should reassign that task to someone else. Following the same logic, private assets shouldn't stay indefinitely on the Fed's balance sheet. Those assets should be swapped for U.S. Treasury securities, again, preserving the Fed's operational independence and its designated scope of responsibility. Now I'd like to focus on the rationale for establishing simple policy benchmarks. Turning to exhibit number 2, you can see that as of last June, investors saw roughly 50-50 odds, just like a coin flip, that the Fed would hike interest rates in December. Those odds edged down during the summer, but then skyrocketed in early autumn, not because of some startling new economic data, but simply because Fed officials started signaling a rate hike through their speeches and interviews. In fact, as you see in the exhibit, investors now see the rate hike in December as a practical certainty, even though the FOMC won't be meeting until mid-December, almost 6 weeks from now. Evidently, the strategy underlying the Fed's decisions is not very well understood, even by investors who sift through every tidbit of Fed communications, and much less so by members of the general public. By contrast, simple benchmarks can provide a transparent means for the Fed to communicate its strategy. It's really important to note here, such benchmarks are not intrinsically hawkish or dovish. For example, Janet Yellen, when she was vice chair in 2012, referred to one such benchmark as the balanced approach rule because of its effectiveness in fostering the Fed's dual mandate of maximum employment and price stability. Turning now to Exhibit 3, you can see here that a balanced approach benchmark provides a remarkably good approximation to the Fed's actual policy path over the last few years. In fact, this benchmark is essentially the same as one I presented at a conference on full employment that my colleague Jared Bernstein organized back in 2015. This exhibit shows, it confirms, that simple benchmarks can be helpful in clarifying the Fed's monetary policy strategy. That will contribute to its overall transparency and accountability to the Congress, its boss, and to its effectiveness in serving the American public. Thank you for your consideration. I'll be glad to answer any questions.
Thank you, Dr. Levin. And Dr. Bernstein, you are now recognized for 5 minutes.
Well, thank you very much. Great to be here. And my testimony conveys a simple message. The independence of the central bank is an essential ingredient to its functioning. Of course, that independence exists within the legal context set forth by Congress, and it's essential for this committee to continuously revisit this context. But maintaining the central bank's independence must always be an elevated consideration. In this context, some of the ideas and the proposals under discussion today are worthy of consideration, but some are too restrictive. They threaten the Fed's independence and add unnecessarily and potentially damaging process requirements that could do more harm than good to the U.S. and even the global economy. Before commenting on the proposals, I'd like to suggest that in an all too other dysfunctional and highly partisan environment, the Federal Reserve is one institution that's been highly effective in carrying out its mission. Though the Fed failed to identify the housing bubble, it quickly moved into emergency mode when the bubble burst and the downturn ensued. The bank deployed its significant weaponry against the downturn, including its first line of defense, reductions of the policy rate and emergency lending. And later, when the policy rate got stuck at its lower bound of 0, the Fed turned to alternative forms of monetary stimulus. While some of these actions are behind the motivations for today's hearing, my assessment is that they were effective in offsetting the historically large demand contraction that followed the crisis. I cite research that tries to isolate the impact of quantitative easing, including bond purchases that would not be permissible, agency MBS, under one of the proposals considered today. These actions were effective in thawing credit markets in hard-hit sectors of the market, noticeably housing finance. Post-recession, the Fed continued to promote the recovery, and the unemployment rate recently fell to what is now the lowest jobless rate in 17 years. In other words, if I were looking around Washington for an institution that fits the adage, if it ain't broke, don't fix it, my first stop would be the Federal Reserve. Among the three proposals under review today, I find the proposal to limit the Fed's independence regarding its emergency lender of last resort function potentially most problematic. Though I recognize the motivation for the proposal, I see two major drawbacks. First, since the crisis, Congress legislated the Dodd-Frank financial reforms, key sections of which were designed specifically to reduce the need for Fed intervention in this space, including a vice chair position for the Fed for financial supervision, numerous restrictions to 13(3) lending authority, and liquidation authority. Dodd-Frank, along with recent international accords under Basel III, also increased the first line of defense against illiquidity and solvency crises, capital requirements that disallow excessive leverage. I see no reason to add new complexities into this system until we give the Dodd-Frank measures a chance. Second, and this is a profound concern with this proposal, it takes the authority for emergency lending outside of the Fed and requires both chambers of Congress to provide a timely 30-day approval of the Fed's emergency loans. I believe this adds unnecessary risk to credit markets and the broader economy. It is an imprudent departure from the lending authority established in 13(3) of the Fed's charter, one that undermines both the independence of the institution and its role of, quote, lender of last resort. With this change, the 535 members of Congress all become lenders of last resort, a possibility I strongly urge this committee to avoid. If Congress fails to approve an emergency lending program within 30 days, the borrower, who by definition is facing a balance sheet crisis, must pay the loan back to the Fed. Moreover, members of Congress and their staffs must quickly engage in highly technical analysis of whether lending institutions are illiquid or insolvent, the quality of their collateral. Such analysis is standard practice at the Fed, but by insisting Congress engage in it as well, the proposal introduces the possibility of politicizing the analysis, and if Congress fails to act in a timely manner, triggering significant market disruptions. I do think the bar should be high for approval of emergency lending, but my bottom line is that clearing that bar should be the purview of the Fed, not Congress. Thus, should the committee consider raising the internal bar within the Fed, inside the Fed, while this should be done carefully and with great attention to potential unintended consequences, it is consistent with prudent congressional regulation. Conversely, raising the external bar by requiring congressional approval goes way beyond this benchmark. The best way to avoid emergency lending by the Fed is to avoid credit bubbles, systematically underpriced risk, and the crises that follow these financial pathologies. And the way to achieve that is through market oversight and regulation. I would also caution the committee against further restrictions on the Fed as to the type of debt they can purchase in their open market regulations. The banks of England, Japan, Canada, and Europe all have few restrictions on the type of assets they can purchase, and this creates a flexibility for their central banks to bring the water to the specific sources of the fire. Thank you, and I look forward to your questions.
Thank you, Dr. Bernstein. And Dr. Levy, you are now recognized for 5 minutes for an opening statement.
I'll start over. Chairman Barr, Ranking Member Moore, and members of the committee, I sincerely appreciate this opportunity. The ultimate objective is healthy, sustained economic growth and rising standards of living. The challenge is identifying the proper policies and the proper mix of policies, fiscal and tax, regulatory and monetary, to achieve desired outcomes. The Fed's emergency measures during the 2008-9 crisis certainly helped stabilize financial markets and avert an even deeper recession. We have to distinguish between the conduct of policy during a crisis and during normal times. The efficacy of the Fed's sustained artificially low interest rates and massive asset purchases once the recovery took hold is questionable and has been the source of undesired distortions and pose very large risks. The Fed's QE3 asset purchases, policy to reinvest all the maturing assets, artificially low interest rates, all of these stimulated financial markets, but they failed to stimulate faster growth. Nominal GDP growth has actually decelerated. the economy would have grown along its modest pace, and job gains would have occurred even if the Fed had not engaged in QE3, and even if it had normalized rates quicker. History shows conclusively that once an economic recovery takes hold, raising rates back to neutral does not harm the economy. But the Fed's extension of monetary policy through uneven discretionary approaches has given a false sense or a false impression that the mandate of the Fed is to manage the real economy and fine-tune it, and that more and more monetary stimulus was needed to prop up the economy. In reality, the frustrating underperformance of the economy reflected the growing web of regulatory policies, government-mandated expenses, and tax burdens. The Fed's extended easy policies did create many distortions and burdens. Let me mention a few. Tens of millions of primarily older people face low yields on their savings. Tens of millions of renters face higher rental costs as real estate prices have moved up, stimulated by the Fed. Moreover, the Fed's $4.5 trillion portfolio involves enormous risks. The CBO estimates that a 1 percentage point increase in interest rates would increase budget deficits by $1.6 trillion over 10 years. Take this risk seriously. My recommendations are the Fed must continue to normalize interest rates as it has been. With regard to inflation, the factors that have brought down inflation recently below the Fed's 2% target are good for the economy and increase purchasing power. The Fed should not express so much public angst about a non-problem of low inflation. In fact, economic growth, business investment, and real wages are picking up momentum, and confidence is elevated despite the Fed hiking rates. The reason for this is largely the government's recent changes to ease the burdensome regulations and tax reform prospects. Secondly, the Fed and Congress are really too complacent about the Fed's massive balance sheet, particularly amid improving economies. And I urge the Fed to gradually eliminate its entire mortgage-backed securities holdings. With the mortgage market healthy, okay, and housing doing quite well, why is the Fed holding any MBS? Why is it allocating credit to a sector that doesn't need it? Secondly, the Fed should aim to reduce its balance sheet much more than it's currently aiming for. Some Fed members are talking about lowering it from its current level to about $3 trillion, which would still leave a trillion in excess reserves in the banking system. We need to assess the costs as well as the potential benefits of that. What might be the costs? Its involvement in fiscal policy, paying interest on excess reserves, the Fed's expanded footprint in financial markets. Thirdly, the Fed and Congress should adopt a rule to establish and prevent the Fed from ever purchasing equities under any circumstances. Finally, and most importantly for the future, the Fed really needs to reset monetary policy. It should have a flexible rules-based approach. And by flexible, what I mean is follow a rule as a guideline that will improve transparency and your committee's ability to supervise the Congress while at the same time giving the Fed substantial or any types of discretion it needs during emergency situations. Thank you.
Thank you all for your testimony, and the chair now recognizes himself for questions for 5 minutes. So last year, a research team from the University of Chicago, Northwestern, and Stanford published an article in the highly regarded Quarterly Journal of Economics. And that article found that uncertainty about economic policy in general reduces American investment, output, and employment. And just last month, a team at the Federal Reserve, researchers at the Fed, found the same problem with monetary policy. According to their study, quote, uncertainty about monetary policy increases credit spreads and reduces output. Dr. Plosser, you've served on the Fed's Monetary Policy Committee. You are an accomplished economic researcher. Do these findings from both the Fed and from the various academics, do these findings seem reasonable to you, that uncertainty about where monetary policy is going can in fact slow our economy and constrain credit availability?
Thank you. I think the answer is yes. They certainly make sense. I think there's a challenge in how you quantify those effects, but you can see the uncertainty showing up in a number of different situations. Think about the uncertainty of credit policy, about how much MBS was going to be bought and how much not. Were they going to rescue Lehman Brothers like they rescued Bear Stearns? Without articulating a policy strategy that guided those decisions, it resulted in uncertainty. The taper tantrum, as they said, that occurred. All those are examples of effects in the markets that came about through some uncertainty or through doubt about whether the Fed was going to follow through on some of its pronouncements. So I think it's very important that, yes, I think that uncertainty can matter. How and when it shows up is a bit of a challenge, but that just says that the Fed needs to be more strategic in articulating a strategy about how it's going to behave if certain things happen.
Thank you. And Dr. Levin, you too are an accomplished economic researcher. You've advised both Fed Chairman Bernanke and then Vice Chair Yellen. And in addition, you co-authored an article last year with the Fed Up Coalition's campaign manager calling attention to the importance of transparency for our monetary policy authority. And acknowledgments for that article included Dr. Bernstein, who joins our panel today. The article called for the Fed to include in its monetary policy report a discussion of any economic models and benchmark rules that are used in setting the course of monetary policy. Dr. Levin, does the discussion draft that you have before you today, the Monetary Policy Transparency and Accountability Act, does that bill, as currently drafted as you see it, effectively achieve that goal without mandating the FOMC to follow any particular mechanical rule?
Well, thank you, Mr. Chairman. So first of all, I just want to go back to something that Congressman Sherman mentioned before. The Fed serves the American public, and I think that it's appropriate for Congress to think carefully about how to make sure the Fed is a fully public institution. That was the key point of the paper that we wrote last year. It's critical for the Fed to be diverse, regionally diverse, diverse in respect to the policymakers and the staff who are working at the Fed. Those are all critical issues that were in that paper. But on the specific issue, I think that, as I said before, clarity of a benchmark rule would help serve the public. It's related to your question to Dr. Plosser. It would help alleviate uncertainty in financial markets and more generally businesses and consumers, the strategy the Fed is following. So I think it's appropriate in your draft legislation that the Fed have a simple strategy that it can explain to Congress and the public. Ideally, it would choose that strategy at the beginning of each calendar year. And of course, during the year, unexpected things might come up, and then the Fed officials would explain if they need to change the strategy or deviate from the strategy. So in that sense, I agree with you that this is a reasonably flexible approach. They would help improve the Fed's transparency. The Fed needs to have discussions among experts like Dr. Plosser was, with different points of view. Some people think that the Fed should continue to normalize the policy rule that I showed you on the chart. It's not so clear, because if inflation stays around 1.3%, where it is today, and output's just growing at a sustainable pace, then that rule would say that there isn't necessarily such a strong case for the Fed to raise interest rates further at this point. But again, that's the sort of debate that should happen at the Fed. The Federal Reserve would choose the benchmark under your legislation, and it would be able to change the benchmark, but it could use that as a point of reference. And so I think this would be a very constructive way forward.
Thank you. And I'd like to ask the same question to the other two witnesses, but my time has expired, so we now move to the distinguished gentlelady from Wisconsin, the ranking member, Ms. Moore, for 5 minutes.
Thank you so much, Mr. Chairman. If I have understood the testimony we've had here today, it seems like there's not that much disagreement with regard to the Fed having taken the appropriate emergency lending authority, but then it seems to differ after that point. Dr. Bernstein, let me start with you. I'm not trying to pick on you, Dr. Levy, but I just underlined some stuff in your testimony that I thought was very interesting. You thought that the economy's lackluster response to the Fed stimulus highlights the important influences of other policies and factors, and you talked again about Dodd-Frank, the government tax and regulatory policies at both the state and local levels, in both the financial and non-financial sectors, the Fed paying interest on reserves, and you know, saying that the banks just can't lend because they're just so burdened by regulations. Now, the banks are doing great last time I checked. They're very profitable. And Dr. Bernstein, I think we heard you say and talk about in your written testimony that we saw unemployment fall to 4.1%. What am I not getting here between the two of you?
Well, I think you raised some great points, and these thoughts came to mind listening to Charles Plosser also talk about the impact of Fed-induced uncertainty. In fact, unemployment is historically low. We're creating something like between 150 and 200,000 jobs per month. That's a strong clip of job creation at this point in the cycle. I suspect all of my colleagues would agree with that. The GDP is growing slower than we might like. That's a function of low productivity growth, and I haven't heard any convincing arguments that would connect Federal Reserve policy to that. So I think that if you're looking at economic conditions and you're trying to make a case that the Fed is somehow doing the wrong thing, you have a very high bar to cross. As far as the crisis goes, many of the policies that are taking a bit of a hit from my colleagues up here have been shown not only to be effective in pulling the recovery forward, but as I dictate in my testimony, looking at a wide spate of research, are associated with much quicker GDP growth, much lower unemployment, and including some of the bond and purchases and emergency spending programs are associated with significantly lower interest rates in those sectors that clearly were important to growth. If anything, it's my view that what's held back faster growth in terms of a policy setting was austere fiscal policy, not monetary stimulus.
Right. Okay, so you talked about what if the Fed had been prohibited, as this legislation suggests, from purchasing treasuries in response to the 2008 crisis? If we had the policy that would limit its purchases, what do you think would have happened?
Well, John Williams of the San Francisco Fed is, I think, a very highly respected empirical macroeconomist. He argued that the MBS purchases were, quote, the most effective part of the Fed's asset purchase programs, and that they, quote, ended up having a kind of a bigger bang for the buck than the Treasury purchases. I quote research by Alan Blinder, former vice chair of the Fed, and Mark Zandi, highly respected economic researcher, that underscores Williams' finding. Within a short time, they write, the MBS purchases by the Fed meant that, quote, home buyers with good jobs and high credit scores could obtain mortgages at record low rates, which helped end the housing crash. And in my testimony, I not only underscore those results, but I urge the committee to look at the potential for other asset classes that the Fed might be able to purchase depending on the nature of the crisis. And I suggest municipal bonds might be one area to look at.
Well, the heart of the financial crisis was in the housing sector. So do you agree that that was good for the Fed to target that sector?
In a sense, we were, quote, and these are very big air quotes, lucky, because the Fed, within its charter, was able to purchase assets from the very sector that took the hit, the housing sector. That might not be the case next time.
Okay. Thank you. I think I will yield back the balance of my time since we went over last time.
The gentlelady yields back. The chair now recognizes the vice chair of the subcommittee, Mr. Williams from Texas.
Thank you, Mr. Chairman, and thank all of you for being here today. This subcommittee is grateful to have the testimony of so many of you, and we appreciate it on a very important topic. As vice chairman of this subcommittee, I've been privileged to work with my colleagues and industry experts to ensure that the Federal Reserve does not step beyond its intended purpose and authority and continues to play an independent role in monetary policy. I consider today's discussion a pivotal step in the right direction. I look forward to working with the chairman and the distinguished members on these issues. So, Mr. Plosser, my question to you is, in March, you stated during an interview that you are concerned about preserving the fragility of independence as Congress considers reforms to the Fed. Now, based upon your previous role as President and CEO of the Federal Reserve of Philadelphia, do you feel that the reforms being considered today would help to maintain that independence?
Thank you, sir. I do. I think, as I talked about treasuries and about political interference or political involvement of Fed in its own decision-making and pressures, both politically and by the public, I think it's very important that we separate clearly the responsibilities of the fiscal authorities from those of the monetary authorities. The more those responsibilities are blurred and overlap in some ways or have dual responsibilities, the harder it is to hold either party, Congress or the Fed, accountable for the decisions that they make. So it's really important, I think, to keep a line between monetary and fiscal policy. And one of the things I've argued is rather than undermine independence of Fed's monetary policy making, it would be better to narrow the scope of their responsibilities in a way that help them focus on things that they can control and ultimately Congress wants them to do. So this separation between monetary and fiscal policy, I think, is an important aspect. And I think the way the bills are written and go to a Treasuries-only policy and to provide mechanisms for emergencies should they arise, it holds the right parties accountable at the right time.
Okay. Do you think there's any areas where you feel that the Fed is currently acting beyond its jurisdiction?
I can't think of any right at the moment.
Okay.
I mean, they're beginning to unwind their balance sheet, as was said. I wish they could do it a little faster, I think, because I think that's
Would
going to pose a
you talk closer to the mic, please? Thank you.
Sorry. I think they're not doing anything immediately that's not appropriate. They are unwinding their balance sheet. I wish they would focus more on unwinding from the MBS and shrinking their balance sheet a little bit faster. In fact, I think that's actually more important right now than raising interest rates.
Okay. Mr. Levy, thank you for being here today. In your testimony, you acknowledged, rightfully so, that the actions of the Fed following the economic crisis have, in your words, extended the role of monetary policy beyond its normal scope. You say that the Fed's position that QE3 was responsible for increases in employment and economic expansion reflect a great deal of hubris. I would tend to agree with you. Do you agree with the characterization that the purchase of mortgage-backed securities by the Fed is a dangerous long-term strategy?
Yes, I agree. Particularly, we have, once again, the Fed's original purchases of MBS, November 2008, was, as Chairman Bernanke said, an absolute emergency. The MBS market was frozen and really threatened the global financial system. We're no longer in an emergency. Financial markets are normal, mortgage markets are normal, housing markets doing just fine. Why is the Fed the largest holder of MBS in the world? It just absolutely doesn't make any sense, and it's not a good long-run strategy. So once again, I think we need to distinguish between the proper role of the central bank during an emergency and the proper role during normal times, and we're certainly in normal times now.
Okay. Let me ask you another question. Will the proposals before us help to successfully unwind the excessively large balance sheet of the Fed, do you think?
Excuse me, sir, maybe I didn't hear.
Yeah,
that.
will the proposals before us help to successfully unwind the excessively large balance sheet of the Fed?
It won't hurt it, but it doesn't directly address it. I mean, so right now, the Fed's strategy for unwinding its balance sheet ever so gradually and passively effectively involves reinvesting all but about 97% of MBS and Treasury holdings, this very gradual unwind. And it's a step in the right direction, but I think it should be more aggressive because once again, I don't think the Congress or the Fed are really considering some of the risks involved, but not just the Fed stepping over the bounds into fiscal policy, but there are just massive risks, including the risk that Congress thinks of this as risk-free money to spend.
The gentleman's time has
dangerous.
expired.
Thank you, Mr. Chairman.
Thank you. The gentleman's time has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Mr. Chairman, I want to thank you for putting up a quote from Congressman Brad Sherman up when it was your time. I can think of no more credible analyst. And you quote me to say that Section 13.3 is still a dangerous code section. Dr. Bernstein points out that because of the other provisions of Dodd-Frank, it's less likely to be needed, which means it's less likely to be abused, but it's also less likely to be necessary. So the question then is, how can we make it even less likely to be necessary? And first thing we should do is break up the too big to fail. Too big to fail is too big to exist. And we should never have a circumstance where the Fed is tempted to use 13.3 or to come to us for emergency legislation, as they did successfully in terms of passing their legislation, by saying, look, if this one entity goes under, it's taking the entire economy with us. I would point out that one thing that 13.3 does not have is a dollar limit. I remember when the chair of the Fed was here and I proposed either a $4 or an $8 trillion limit, and the Fed chair would not go along with that. That was at a time when it wasn't being used at all. So it's clearly Congress should be consulted at some stage. Mr. Plosser, you point out that we should not use 13.3 to help any one individual or company. There is a constant debate in our society between democracy and rule of the philosopher king experts. You'd think that democracy had won that debate. I'm by no means sure. I think that there's general agreement that the people of the country can elect politicians so long as those politicians don't control anything that's thought to be really important. And that if politicians do, that process is known as politicalization of what actually the philosopher kings should control. Mr. Levin, you point out that the Fed shouldn't suffer from second guessing. Welcome to Washington, D.C. I don't think there's a member of this committee who is not second guessed on everything they do at all times. And the financial press seems to exist for the sole purpose of second guessing the Fed. Speaking of whether the Fed is predictable or not, they are absolutely and totally predictable within 0.25%. That's pretty good. Reasonable minds on the Fed can differ to the extent of 0.25%. They are far more predictable than anything else I'm aware of. The problem with the Fed balance sheet is that they're shrinking it when they should be growing it. You can say there's no crisis, but wages remain stagnant. That leads to divorce. It leads to drug abuse and opioid use. It leads to broken families. It leads to a host of problems that we would not have otherwise. And so it may not be a crisis for the whole country, but is a crisis for millions of families. Let's see. So I want to focus, since I've got Dr. Bernstein here, on the tax provisions. We were talking about those earlier. And I do want to thank, as long as the majority has put my quote up on the board, knowing that I should follow their lead. I've also put my own material up on the board. And I want to point out that the abandonment of quantitative easing is going to cost our Treasury between $80 and $100 billion a year. And we live in this strange world where almost everyone except our witnesses is unaware, and some of our members is unaware, that this money is coming into the Treasury. And then our witnesses live in a world where that's shameful because it's unintended, because that isn't the purpose of the entity. I'd say that if if you're in the private sector and your byproduct starts making you huge amounts of money, that creating the byproduct becomes one of the purposes of the company. But Dr. Bernstein, the models on the effect of this tax law, do they deal at all with the increase in the trade deficit due to the strengthening of the dollar, due to the increase in federal borrowing?
I know my time's up. I'll answer you with one sentence. The theory of the case on the tax cuts is that the cut in the corporate rate will draw in capital flows from abroad, and those will increase the trade deficit.
Gentleman's time has expired. The chair now recognizes the gentlelady from Utah, Ms. Love.
Thank you. Thank you all for being here. In previous hearings regarding the Fed and monetary policy, we had discussions about the Fed being just as bad as everyone else at economic and financial forecasting, despite having an army of PhD economists running complex computer models. Why do you think the Fed is so bad at forecasting? And I was wondering if I can get your thoughts on that, Dr. Plosser.
I think that economists in general are not that great of forecasters. It's just the reality of it. Much of the things that go wrong with forecasts are things that are events that occur that weren't forecastable and therefore cause problems. I also think that actually raises the importance of the distinction between what we might call a rules-based strategy and a discretionary strategy. Discretionary strategy says the Fed will do what it wants to do when it wants to do it for reasons that it feels it wants to, okay? That's very unpredictable as to how that's going to respond.
Right.
But the future is uncertain, always has been uncertain and will continue to be uncertain. The value of many of the rules-based strategies and the strategies where you articulate, well, what will the Fed do if this or this happens?
Right.
All right? That reduces uncertainty. You don't have to guess what the Fed will do. It won't make up new reasons for doing the things it's doing. It will be a bit more predictable.
Okay.
Because the future is predictable.
Right.
So I think that we have to just accept the fact that the future is unpredictable and think about strategies that allows the Fed to operate in an unpredictable world in a predictable way.
Okay, I'm glad you said that because I'm trying to figure out a way to do that. So, according to former Federal Reserve Board Governor Kevin Warsh, currency stability is one of growth's best friends. He also worried that the Fed's extraordinary tools, encouraging businesses to favor financial engineering over capital investment, and consequently weakened growth in business investments, is providing to be an opportunity killer for workers. Do you agree with that assessment or disagree with that assessment? Yes, I'm still sticking with you, yes.
I apologize. I'm sorry. I thought you were talking to Dr.
No.
Levin. I agree with most of it. I do think that many of us said during both a very low interest rate period when we reached zero and during quantitative easing that much of the effects of those efforts were absorbed in financial reengineering by companies, sort of restructuring corporate debt policies. And one of the big puzzles for the recovery, and one of the reasons it was slow, was the fact that real business investment didn't grow like it had in previous recoveries. It wasn't as responsive to the typical tools of monetary policy. We saw this effect in financial reengineering, restructuring of debt, so forth and so on. So I think there's I share a lot of the concerns in that statement. Yeah.
Okay, I want to get to Dr. Levy because we've had an opportunity to discuss this before. You and I have talked in previous hearings about the relationship between monetary policy and employment. And why do you think that the Fed's policies have been such a boom for what Kevin Warsh has referred to as financial engineering, while leaving too many Americans underemployed and barely able to make ends meet?
I mean, this is a great question. So getting back to Dr. Plosser's comment and Kevin Warsh's comment, it's critically important to point out that while the Fed was very successful in lowering the real cost of capital, businesses didn't respond. And they didn't respond for a host of non-monetary reasons, including tax and regulatory policies. Now, to your point on employment, there are so many factors affecting employment and wages that go so far beyond monetary policy. Productivity's been slow. I mean, this should be a subcommittee on education, because let me give you an important statistic. 85 million people, working age population, have a high school degree or less. Wages tend to be low. Monetary policy can't do anything about it. Okay, and you could go through a host of other government regulations. So this is why I'm emphasizing that we all want higher standards of living.
Right.
The issue is, what is the proper role of monetary policy? So the Fed could add on QE 3 and 4 and up to a zillion, and it's just not going to create the type of employment gains and wage gains
Yeah.
that we all really want.
Gentlelady's time has expired.
Thank you.
Gentlelady's time has expired. The chair now recognizes the gentleman from Arkansas. The chair recognizes the gentlelady from Wisconsin.
Yeah, thank you so much, Mr. Chairman. Excuse this interruption. I'd like to ask unanimous consent to place a statement in the record from Better Markets. There was a quote attributed to them, taken from a release issued in 2015 when the Warren-Vitter bill was introduced, and they just want to clarify the differences in that bill and what is being offered here today, just for the record.
Without objection. So the statement will be entered into the record, and the chair now recognizes the gentleman from Arkansas for 5 minutes.
Thank the chairman. Appreciate you and Mrs. Moore convening this hearing, and thank our excellent panel. Appreciate all of your participation as well. This subject of Federal Reserve independence from credit policy is not new to this subcommittee, and so I'm glad we're continuing this discussion. As Marvin Goodfriend, a professor of economics at Carnegie Mellon, said in 2014, I think it was, he summarized it nicely, said, flexibility and decisiveness are essential for effective central banking. Independence enables the central bank to react promptly to macroeconomic or financial shocks without the approval of the Treasury or the legislature. Central bank initiatives must be regarded as legitimate by the legislature and the public. Otherwise, such initiatives will lack credibility essential for their effectiveness. The problem is, which is what we're talking about today, to identify the limits of independence on monetary policy and credit policy to preserve a workable, sustainable division of responsibilities between the central bank and between the fiscal authority. And I think that's really at the heart of what we're talking about today. And if we have an efficient monetary policy, then it helps our private markets allocate goods and services most readily, find their most promising opportunity. And if we engage in what we've done over the past 10 years, we really skew the price mechanism and skew investment. So I really appreciate your testimony, all of your testimony. We've seen around the world unprecedented accommodation, not only here in the United States, but in central banks around the world, where I think Japan now is somewhere approaching 100% of GDP with the size of its balance sheet, and we're at about a quarter of our GDP. And in Europe and in Japan particularly, we have $13 trillion of sovereign debt at negative interest rates. And we've got some of those central banks buying corporate debt and equity obligations, something that we've certainly been concerned about here. So I do think, as the ranking member noted, that there are concrete reasons why we're having this testimony and thinking about why those distorted price signals and the mixing of credit and monetary policy are not a good thing for our country. Dr. Plossner, in talking about Treasury only, I want you to emphasize that we have 40% of the MBS, new issue MBS, owned by the Federal Reserve right now. We have about 15% of the Treasury market, more or less, since the crisis. And I think the last time I looked at their statement, they own 4% of other, which includes Maiden Lane, which I guess is the residual detritus of Bear Stearns. Your concept is that we just simply, whether it's a 13D action or any other action, if we the Fed, take on a non-treasury asset, that in some reasonable amount of time, we ask the ultimate fiscal authority, the Treasury, to take that and swap treasuries back to the Fed. Isn't that what we're talking about?
That's the essence of it, yes, Congressman.
So that doesn't, it doesn't per se that, and I agree with Dr. Bernstein, we've got to be very careful in how that's done and the time frames, and we don't want in a crisis to make things more difficult. But the ultimate issue is that the Treasury, just like that hadn't done a very effective job in getting rid of their final TARP assets, they'd be liquidating Maiden Lane and not leave that over at the Fed. Isn't that an example of what you're talking about?
That's essentially what I've been arguing, exactly that.
And
by the way,
yeah.
Congressman, there was a memo written between the Treasury and the Fed back in 2009, where there was an understanding that the Treasury would do everything, because this discussion started way back then, that the Treasury would do everything it could to relieve the Fed of those private sector assets, recognizing that they were really the responsibility of the fiscal authorities. That never happened, obviously. And so I think this is really about the process of restoring the Fed so it can continue to conduct monetary policy in a manner that's appropriate with treasuries rather than trying to deal with the Maiden Lanes of the world.
Would not only be neutral between the private markets on credit allocation and monetary policy, but also put the fiscal authority, which is under the purview of the Congress, into whether we're going to spend money on one thing or another to, quote, intervene in markets in the time of a crisis. I think you make a good point. I yield back, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Minnesota, Mr. Emmer.
Thanks to the chair, and thank you to this great panel for being here today. I want to follow up on Mrs. Love's questions relating to Kevin Warsh's quote about financial engineering. And Dr. Levy, since you were on this when the time ran out, can you give me some examples of the types of financial engineering that Mr. Warsh was referring to?
Quite simply by keeping rates at zero, so the cost of capital is zero. That gives companies the flexibility to alter their liability structure, alter their capital structure in any way. And the problem you run into is when you're running a company and your Treasury Department starts making too much money and your basic business isn't, things aren't good. I hate to say this in such lay terms, but if it becomes so financially advantageous to take advantage of the current financial system to generate profits, then you take your eye off your basic business ball. And I think a lot of that happens. So once again, if we go back to what the Fed tried to do and was very articulate about in say, it's QE3, Chairman Bernanke, when he rolled it out, says, okay, QE3, we want to pump a huge amount of excess liquidity into the economy, keep rates very low, and through forward guidance, convince markets we're going to keep rates really, really low for a really long time. We want to encourage risk-taking and push up asset prices, and all of that is going to stimulate aggregate demand. It did all of that, but it didn't stimulate aggregate demand. Once again, I'll emphasize, I understand employment went up, but nominal spending growth in the economy didn't accelerate. And so you end up with, so when economists talk about distortions, you can drill down to what it means for household decision-making and business decision-making.
So what do you think the Fed should be doing to encourage capital investment and job creation instead of this financial engineering, instead of making too much money through the Treasury? What would a better approach be?
I think the Fed should proceed to normalize interest rates, and that means, raising rates right now toward 3%. I don't think it should, which would mean a 1% real rate. I don't think it should be sidetracked from that due to low inflation or any international whatever should come up. And I think on its balance sheet, the Fed should, once again, proceed with a strategy to unwind all of its mortgage-backed holdings over, say, a period of 5 years, which is reasonable. You could do most of it passively. You wouldn't have to sell any. And to basically normalize policy and set the record straight about what the proper scope of monetary policy is. And I think that would reduce uncertainty and build confidence in the private sector.
Well, that's interesting, your last statement, because my next question was, in your opinion, has the Federal Reserve done a sufficient job of announcing to the American people a clear and consistent strategy on how it plans to spur economic growth?
The Fed's tried to be transparent, but because it has not had a strategy, it's very difficult to be clear. And so while they talk about transparency, their message oftentimes gets muddled without a strategy. And so once again, I think the Fed should, during a healthy economic period, it should stick to its monetary knitting and not try to get itself involved in fine-tuning the economy and giving mixed signals to markets. And I do think the Fed's forward guidance during parts of this economic expansion, expressing worries that even a 25 basis point hike in rates could generate the next recession, it's certainly not a positive for confidence.
It's not helpful. Thank you. I yield back.
Gentleman yields back. The chair recognizes the gentleman from Indiana, Mr. Hollingsworth.
Well, good afternoon. I appreciate everybody being here. It's a rare day when you face 4 doctors sitting across from you, considered a pleasant experience, right? But I wanted to talk a little bit more about what's been discussed already. And I think that one of the challenges here is, on both sides of the aisle, is kind of confusing the counterfactual a little bit. We say, oh, growth is non-zero, thus things are going great. Bank profits are greater than zero, thus things are going great. But I think the literature looking back on this shows how loan growth has been severely constrained compared to coming out of previous recessions. And so one of the things that I want to talk about was interest on excess reserves, and how that may be slowing banks' willingness to make loans to other credit-worthy borrowers and to mobilize those loans into capital investment. As you well said, Dr. Livy, that investment has certainly been subpar compared to previous expansions. And I guess in my view, and maybe this has gone out of fashion, but in the super long run, it's productivity that generates economic growth, and monetary policy has the ability to move things around on a temporary basis or on a short-term basis, but ensuring that we ultimately create more productive workforce, that we create more productive uses for capital is hugely important. I wonder if you could talk a little bit about how interest on excess reserves may be constraining those investments.
Okay, so the Fed pays interest on excess reserves, and so they put this in place in October 2008, and for a large portion of the period recently, that interest they pay on excess reserves has been above the effective funds rate, and therefore that is, it's one factor, but not the only factor that is probably constrained bank lending. Mm-hmm. I would also note another factor here is that the Fed stress tests, while they have been successful in leading particularly large banks to raise their capital adequacy standards, you know, I can tell you when bank executives deal with stress tests all day long, they're in no mood to make a loan, and the lenders down the hall say, I don't want to make this loan because the risk of making a mistake is very, very large. So I think it all adds up to, you know, I think
if you've got a regulatory environment that dampens loan growth, and then you've got the ability with no counterparty risk whatsoever to earn above market rates at the Fed, why take on risk without any apparent gain, right? And Dr. Levin, I was hoping that you might comment on that as well.
Well, I think I agree with you that the interest on reserves was, granted by the Congress to the Federal Reserve at a time when banks were earning zero interest, and that was viewed as a distortionary cost that was discouraging banks and effectively disintermediating funds from the banking system elsewhere, because banks are required to hold some reserves at the Federal Reserve.
Right.
This is a crucial question. I think that a part of the solution to this, in my view, is that Congress should authorize the GAO to do comprehensive annual reviews of all aspects of the Fed,
Right.
including the monetary policy, including interest on reserves. I think there's a real question in my mind why the Federal Reserve is paying significantly higher rate on interest on excess reserves compared to, say, the rate in the repo market, or the Treasury bill
Certainly
market.
something on our minds as well as we continue to focus on that. Obviously, what we want is capital mobilized in the real economy to make investments, private sector investments, such that productivity will grow over the long run so that we can realize those benefits as Solo predicted. Anything that you wanted to add to that, Dr. Plosser?
So I agree with what's been said, but I would like to go back to the beginning of your statement and remind everybody that one of the dangers that we slipped into during this period, and oftentimes do, is relying on the Fed to be the solution to all our economic problems. And it's not, and it can't be.
Right.
The real key to economic growth is productivity of the workforce.
Productivity generated by private capital, making investments, continuing to grow the economy.
And the Federal Reserve cannot determine that.
I think
It
that's
will
well
not.
said.
And I think we need, and well, you said it, I was just reiterating how important
You know
I
what?
think it is.
I like that even better. And I think the addiction to Federal Reserve intervention, especially as you well said, during positive times of economic growth, continues to endanger their ability to come to any sort of help during periods of great acute stress.
This is the most interventionist Fed in private markets, even today, than it's been in the last 50 years at least.
Thank you, Dr. Plosser. I
The
yield
gentleman's time has expired. The chair now recognizes the gentleman from Ohio, Mr. Davidson.
Thank you, Chairman, and I want to thank our guests. I really appreciate your testimony here and in writing, and I've learned a lot from some of your other writings. So, Dr. Plosser, could you elaborate on some of the real economic opportunities for American households and businesses should they benefit from monetary policy framework that drew a brighter line between accountability for fiscal and monetary policy?
Well, I think there are a couple of ways to think about that. One, it's separating roles and responsibilities and accountability. I think in many cases, households worried a lot about what the Fed's going to do next and what it's going to do to interest rates. And frankly, I believe the Fed is not as powerful over interest rates and the real economy as people seem to believe. If you remember, when the Fed began tapering and stopped buying assets, there was big concern about interest rates, long-term interest rates were going to rise. They didn't. They fell for about a year. So I think that this fixation on the Fed's ability to control productivity growth, real wages, lots of other things is overblown, and that we need to scale back those expectations and look for things that focus on productivity that can make the economy grow, and that's what's going to make the real lives. The contribution of the Fed is going to be mainly keeping inflation low and stable. That's Alan Greenspan used to say when inflation becomes a non-issue for people's lives, then we're doing okay.
Terrific. One of the things that have made inflation such a constrained thing hasn't really been monetary policy, but it's been the strength of the dollar and the power of trade, some of those dynamics that have taken place. Of course, some of that's led to challenges to the U.S. as the de facto reserve currency. Dr. Levin, I was wondering if you could comment on that as a future challenge and what role the central banks, in this case the Fed in particular, could play.
Well, I think that the Federal Reserve is the most important central bank in the world, for sure. And it's not just Americans who want to understand better what the Federal Reserve does. It's true all over the world. other central banks are also trying to understand what the Fed's decision is, what its strategy is. So I want to come back to this question about strategy for a second. I think one way to think about this, the purpose of the legislation you're adopting today is maybe relatively innocuous during normal times. Some of it's specifically directed toward emergency credit and toward actions that would happen in an emergency. Even the benchmarks, I think, during normal times, it's true that for example, the Federal Reserve barely changed the federal funds rate for a number of years in the 90s when the economy was on a steady course. I think the purpose of this legislation is to have it in place the next time around. What are the contingency plans the Federal Reserve is going to follow? Those should be clarified in advance. I remember I was at the Fed at the time. People referred to it as throwing spaghetti at the wall to see what sticks, and that's not an appropriate thing to do. It's important for Congress to understand ahead of time what the Federal Reserve is going to do in an emergency. The strategy for monetary policy, I think of as a little bit like a patient who's a child, and you are the patient's family in some sense, who needs to consult with a team of doctors that you respect and trust, but you want to consult with them and understand the strategy that's being followed. The strategy, it has to be one strategy. And it's absolutely true, the economy has lots of uncertainties. Someone asked earlier about forecasting, but a good team of doctors is going to say, look, here's some risks. We have to take seriously those risks. If this materializes, here's the action plan we're going to take. And so these are the sort of things I think you're asking the Federal Reserve to start doing. Again, it's not hawkish or dovish. It's good governance here and accountability and transparency. It'll help the world economy.
Correct. And so I agree, and I think the challenge when you talk about the Emergency Lending Act, when you look back, so this was forward-looking. Now if you say, well, let's say that there is this accountability and we have the check, what do you see the implications of a potential reversal with the congressional accountability to say, you've done emergency lending, we think that was a bit of an overreach. What do you see as the implications for that level of accountability?
Okay, so the critical thing, again, just use this analogy with the patient and the patient's family and the doctors. Try to consult ahead of time so that by the time when the operation, again, I strongly believe you can't micromanage the Fed. It has to be able to make decisions on a day-to-day basis. But what the Federal Reserve should be doing is consulting in advance to say, if this happens, we may need to carry out this emergency procedure. And the patient's family gives a directive to say, okay, we can live with that. So the up or down vote that this legislation is proposing, hopefully what would not happen is a panic. What would hopefully be happening is, oh, okay, the risks are increasing. We need to launch this emergency facility. And Congress says, yes, you've been explaining that to us for a number of months or years, and we're comfortable with your going ahead.
Thank you. My time has expired. I yield.
Yes, the gentleman's time has expired. Chair recognizes the gentleman from West Virginia, Mr. Mooney.
Thank you. My question is primarily aimed at Dr. Levin. And first, go Big Green, Dartmouth class of 1993 here. I'll be heading back for my 25th reunion this summer. Maybe I'll see you up there. But you've touched a theme that has been of concern to me for a while, of Congress delegating, giving up, just receding its authority to federal administrative branches. I see that in a lot of places, not just with monetary policy. I see it with environmental policy in my state of West Virginia. I've seen it with, even declaring war on foreign countries, going to war on foreign countries. I mean, we're seeing it in a lot of places. And I think Congress needs to reassert itself. In the written testimony, I want to reference the written testimony from Mr. Bernstein, where he emphasized the importance for Congress to maintain central bank independence and, quote, efficient functionality, close quote. So, Dr. Levin, does the draft legislation that you reviewed for the hearing, do you believe it compromises monetary policy independence or compromise efficient functionality, as your colleague has expressed a concern about?
Okay, look, there's the broader picture and then there's the details. So let's just start with the broader picture. That's why I started with the exhibit, basic management principles. The Congress has to be the boss. The Federal Reserve is not an independent branch of government. It reports to you. And it's absolutely essential for you who are elected officials by the public. I agree with what Congressman Sherman said before. You're the ones who are elected by the public to oversee the Federal Reserve. It cannot be truly, absolutely independent. It has to be conditionally, operationally independent. Now, I think this draft legislation at a fundamental level is consistent with the operational independence. In fact, I think, as Dr. Plosser said, I think it would strengthen in some ways the operational independence of the Fed. There are details of some of these things about how many days, for example, that before the congressional approval has to be given, which exact types of securities under which conditions can be purchased. I understand that your committee is going to be marking up this legislation next week. It seems to me that there may be some room for consultations and compromises, as you always do. But again, this seems to me as a matter of good governance and transparency and accountability, and I hope there's a way forward to enact this.
Okay, thank you. Mr. Chair, I'll yield back. My time back to the chair.
The gentleman yields back. The chair recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman, and sure thank each of you for being with us today. It's an honor to have you join this committee. I would like to follow up, if I could, on some of Mr. Williams' questioning. Mr. Levy, if you could just expand further on what you believe to be the economic risks that are created by maintaining a balance sheet of the current size.
There's economic and interest rate risks, and there's also political risks. As far as the economic risks go, the Fed at its peak remitted about $115 billion, I think in fiscal year 2015. Now it's remitting about $85 billion. It's paying IOER, and bond yields have come down some. This crosses the boundary of monetary policy into fiscal policy. If it sounds okay because it reduces the budget deficit, but that is temporary, and it's very risky because, as I noted, if interest rates rise by 1%, which is very consistent with the Fed's expectation that rates are going to rise, and inflation is going to go to 2%, then that's going to add $1.6 trillion to the deficits, and so that's a risk. And the other risk is political, and that is, it's too easy for Congress to look at this as risk-free money and to spend it, and to look at the Fed as a source of risk-free money. And doesn't this jeopardize the independence of the Fed? And Dr. Plosser pointed out that in December 2015, the Fed, in order to pass the FAST Act, the Congress actually borrowed some of the Fed, took some of the Fed's assets, and this is just inappropriate. It's an inappropriate use of monetary policy, and so the Fed, by doing what it's doing, has this political and economic risks, and it's kind of egging on the Congress to take advantage of it in bad ways.
Excuse me, can I?
Yes.
If
Please,
don't
Mr.
mind,
Dr.
just to
Plosser.
elaborate a little bit as an example. The danger is, last time I testified here last year, one time I got asked, well, why shouldn't the Fed fund our infrastructure projects by blowing up their balance sheets some more? There's a real problem in many central banks around the world with exactly that. The Bank of Switzerland, for example, has a very large balance sheet. It's mostly made up of foreign reserves, or currency reserves. They're in a deep political battle because some parties within Switzerland want to use that balance sheet to invest in green energy, Swiss companies, other types of activities in the name of diversifying the Swiss National Bank's balance sheet. If the Fed maintains a large balance sheet that's not tied to monetary policy, the use of that balance sheet the temptation to use that for other purposes is going to be great. And I think the idea of shrinking the balance sheet and tying it to monetary policy will constrain that activity and actually protect the Fed from abuses and prevent it from undertaking its own abuses of its balance sheet.
Yes, sir. As a follow-up, would you say then that it's time for the Federal Reserve to get out of the business of engaging in credit policy?
Yes. The Fed should set out a strategy to wind down its MBS holdings. There's no reason at all for the Fed to hold MBS unless in an emergency situation. It can do so over, say, a 5-year period through passively unwinding the portfolio in order to give the mortgage market time to adjust. It need not sell any to do that.
Can I make a quick comment, if that's okay?
You can.
Anytime the Federal Reserve engages in monetary policy, it's raising or lowering interest rates, and that's credit policy. So I'm not sure I understand this distinction at all.
The time I'm sorry.
Quickly.
A quick answer. The time is,
Okay.
the gentleman has expired. So
The quick answer is the Fed, by holding MBS securities, is specifically biasing the mortgage market at the expense of other credit markets.
Thank you. My time has expired.
The gentleman yields back. The chair now recognizes the chairman of the Capital Markets Subcommittee, the gentleman from Michigan, Mr. Huizenga.
Thank you so much. Sorry I was a bit late earlier. I was actually had a couple of bills on the floor that we were moving forward with, and those duties kept me there. Before I launch into it, I thought it was interesting, the ranking member submitting a statement from Better Markets rebutting themselves, basically a situation where they, I believe, found themselves inadvertently supporting us and what we're doing. And heavens forbid, we wouldn't want to actually come to consensus and move forward on something. So whether it's Warren Vitter or Barr Moore, I don't care. Whatever the title and label might be, let's get some of these things done that have broad, wide consensus and not be political about it. So off of my soapbox on that. Dr. Levy, just want to touch base. Obviously you watch financial markets around the world and on a regular basis and see the real effects, how monetary policy increases those spreads and decreases economic growth. You've talked about this in the past. And I'm curious if you could just comment on how important it is for this legislation to sustain or even improve upon the stronger economic data which we've seen over the last couple of quarters.
I think by normalizing monetary policy, it would take away the monetary crutch from the economy and financial markets. It would not harm the economy, and it would lead financial markets to be much healthier. The other point I would add is by and here I just applaud what Dr. Levin has emphasized. If the Fed actually had a single, understandable, and cogent strategy, it would certainly make it easier for the Fed to convey that message. It would build confidence. And once again, the proper role of the Fed, we've seen it go far beyond its scope. Its discretionary policy has created uncertainty, and I'd really like to see more of a strategic approach that lays that foundation for the economy to grow at a healthy rate, and financial markets adjust.
I think many of us are looking forward to the strategy as you just laid out. Dr. Plosser, good to see you again, and I want to talk a little bit about your article you wrote for the Hoover Institute entitled "Why the Fed Should Only Own Treasuries." In that article, I want to quote you, if that's all right. History teaches us unless governments are constrained constitutionally or by statute, they often resort to the, quote, printing press to avoid making tough fiscal decisions. But in a democracy, independence must come with limitations on the central bank's authorities and discretionary powers. Otherwise, central bankers can use their powers to venture into policy realms unrelated to monetary policy, especially fiscal policy, which more appropriately rests with elected officials. And as you know, obviously, those Fed balance sheets have not only increased in size during the financial crisis, they added large quantities of non-treasury securities, I think, as you put it. Your article highlights the more troubling loans under Section 13.3 that, quote, amounted to debt-financed fiscal policy without the explicit authorization of Congress. So, Dr. Plosser, in your opinion, what are the downside risks of blurring these lines of accountability for monetary policy and fiscal policies?
Well, I think, as we've been talking off and on this afternoon, that it is that blurring that's dangerous, because what that does is confuses both in the eyes of the fiscal authorities and the monetary authorities and the public who's responsible for what, and who do we hold accountable for what. And when you put taxpayer money at risk and you buy portfolios of private assets on the bank's part, you are, in fact, putting taxpayer money at risk, and you are investing in whatever it happens to be, MBS mortgage portfolios or whatever happened to be on the balance sheet that the Fed chose to buy. You are taking fiscal actions.
Is your concern sort of a winners versus losers, and these governments kind of picking it, or just in general, sort of like, and I'm a huge fan of the Swiss normally, but I would hope that they don't head in the direction that you described, you know.
Well, they're getting pressure to head in that direction. That's absolutely true.
Yeah, and we have had that, and the downside of that seems we're allowing a central bank to venture into some waters that it just has no business going. Is that your opinion?
Yes, it is, and it's a bit of a slippery slope, because it's very tempting on the part of both parties to let that. But then it's hard to hold the Fed, to make it transparent, and to hold it accountable for the kind of things that you actually want them to be focused on.
Right.
And the same thing for the fiscal authorities, by the way.
Thank you. Thank you, Mr. Chair.
The gentleman's time has expired, and the members have requested a brief second round of questions. If the witnesses will indulge us with their considerable expertise, this has been a lively discussion. We appreciate your expertise so much that members would like to ask you a second round of questions. So I'll start that second round with by yielding myself an additional 5 minutes. Picking up where Chairman Huizenga was going right there on the downside risks of blurring the lines of accountability for monetary and fiscal policies, Dr. Plosser, let's talk about the legislation that is before you right now. And the Independence from Credit Policy Act, which is one of the 3 bills there. How well does that legislation help the Fed avoid that downside risk of blurring the lines of accountability between monetary policy and fiscal policy?
This is a topic I've been talking about actually since 2009, was when I first raised this question and asked for a new accord. And the problem is that what I see in the legislation and what I've advocated in the past has been this idea that, look, 13.3 had never been used since the Great Depression. It's not something you're going to rely on very frequently. But my view is that it shouldn't be the authority of the Fed to lend money for the purchase of Bear Stearns and buy assets, private sector assets. That belongs to the fiscal authorities. And so I actually think that the Treasury Secretary needs to instruct the Fed to carry out such an action. Maybe it was all decided in consultation with the Fed and other regulators about what needed to be done. But it needs to instruct the Fed so that this is not, the Fed can't take this on its own.
And Dr. Plosser, is it an appropriate solution to require this swap of treasuries for mortgage-backed securities?
The Fed is the fiscal agent in many cases for the government. In most cases it is. And so it's appropriate for the Treasury to instruct the Fed to do something on behalf of the government as their fiscal agent, but then to keep the Fed whole, you engage in a swap of those private sector securities for treasuries, and then the Fed is back to where it was before, and it's not responsible for that. It's in the Treasury that makes it.
So the fiscal responsibilities remain with Treasury.
Exactly.
The agency responsibilities, the monetary policy responsibilities remain at the Fed.
Right.
Let me also allow you to respond to the typical criticism of Fed reform initiatives, and that is that when Congress intervenes in this way and proposes reform, that in fact Congress is compromising the independence of the Fed. Could you elaborate on your argument that no, in fact, this legislation preserves the independence of the Fed?
So that's exactly right. I think it helps the Fed because what it does is when Congress, for example, comes to the Fed and say, we want you to pay for part of this transportation bill or infrastructure bill or what have you, would you buy some municipal bonds or something to help bail them out? The Fed has a basis for saying, no, that's not in our purview.
Okay, so now Dr. Bernstein and Dr. Levy had a kind of an exchange there. Dr. Bernstein made the point that productivity levels are not the result of unconventional Fed policy or discretionary Fed policy. Dr. Levy, perhaps low productivity is a function of a lot of things other than monetary policy. I think there's an agreement on the panel that that is the case. But could you address the issue of what unconventional monetary policy does to impede maximum economic outcomes?
Okay, so unconventional monetary policies during emergencies don't impede. During normal periods, they distort financial markets by keeping rates too low, having excess liquidity in the economy, and this leads to a misallocation of resources. But I would say, as long as inflation stays low, it doesn't have a significant depressing impact on productivity. Productivity is a function of a whole host of other issues. I'd say there is the long-run risk of being excessively easy. It catches up with you, and it could lead to undesired increases in inflation and interest rates.
And so what I've heard here today from the witnesses is that the principal contribution that monetary policy can make, however limited that contribution can be, is primarily that it can provide, it transmits price signals, clear price signals to actors in the private economy, which in turn can provide a level of certainty for households, investors, and small businesses. And
Yes.
I think that's what we're trying to get at with the strategy-based monetary policy. My time has expired on my second round, and I'd like to now recognize the ranking member for an additional 5 minutes.
Thank you so much. Let me just open up by asking Dr. Levin a question. You were a former staffer at the Federal Reserve, so I think that what you might have to tell us is very instructive. You attached to your written testimony a paper that you co-authored with several other people stressing the importance of diversity at the Federal Reserve. What was the essence of that? Just very briefly, why do you think that that's important? And what were you talking about in terms of diversity?
Okay, well, there's a couple dimensions of this that are important. And Jordan Hedler, who's one of the co-authors, is actually sitting here. Valerie Wilson from Economic Policy Institute was the other co-author. The three of us wrote this together. But let me just give you a couple kind of key points. First, as I said in my statement, the Fed is America's central bank. It serves the whole public. Its decisions affect everyone. So there's a kind of chain of accountability here. The Federal Reserve reports to Congress, but the Federal Reserve serves the public. And so it's critical for the Congress to ensure that the Federal Reserve is serving the public as well as possible. A key part of our report is that the regional Federal Reserve banks are legally private institutions. Now, it was set up that way for good reasons in 1913. But you should understand that as of today, the Federal Reserve is the only major central bank in the entire world, the only one that has such a significant private component to it. And so I think it's important for Congress over time to revisit this issue. One possibility is to appoint a Centennial Commission. Some people have raised this idea. And that could be, I think, a bipartisan initiative to say that we need to reconsider this. Some of the rationale for what the Fed did 100 years ago, it was banker to the banks. That was its primary role.
Thank you. That's very helpful.
Okay.
Dr. Bernstein, outgoing Fed Chair Yellen has shared with us many times that she believes that inequality is very dangerous. And so as I have thought about the testimony here today and, an assessment and evaluation of what the Fed did do or didn't do, one of the things I know this is our dual mandate to look out for those who are unemployed. Can you share with us whether or not you think some of these analyses are the way they are because there's sort of not a deference to that other dual mandate? And what is your view on inequality and the danger to our growth?
Well, I'm glad you raised that because I think that those kinds of concerns have been really conspicuously absent from this discussion so far, and it's a glaring absence. So much of the discussion has focused on credit markets, on how the financial sector is doing, on messages and signals and certainty to the financial markets. That's all critically important, no question. But in fact, if you look at the sector that the economy that's really been doing great in recent years, it's precisely that side. The share of national income going to profitability, the equity prices of the financial markets have been extremely strong. Where we have problems, even at 4.1% unemployment, is pockets of weakness in labor demand, pockets of severe weakness in income growth. And it's that reason that the Federal Reserve has engaged in lots of the initiatives that have taken a hit here today from my colleagues because interest rates are stuck at zero. The federal funds rate's been stuck at zero. And so they needed to engage in other techniques in order to try to further stimulate the economy to reach those who've been left behind. If you listen to Janet Yellen talking about either this problem, the employment side of the mandate, or inequality, you'll very clearly hear those concerns. And so we have to acknowledge that there are a lot of people who are missing in this room today from this discussion, and they're the people who are helped most by the employment side of the dual mandate. It's been a critical omission, I think, for much of our discussion.
Anybody dying to say anything up there?
Well, I just want to reinforce what you said about diversity. It's critical for the members of the FOMC and the Federal Reserve Board, but all the regional Fed presidents, to have geographical diversity. That's why it was created as a regional system. That's really important. They need professional diversity, different educational backgrounds. It's great to have a congressman.
You need any black people on it?
Absolutely,
Right.
of course.
Okay.
Because
my time has expired.
Yeah. Okay.
The gentlelady's time has expired. The chair recognizes the gentleman from Texas, Mr. Williams.
Thank you, Mr. Chairman. Mr. Levin, the FMOC proposal before this body today seeks to increase transparency and make clear the way that the FMOC makes its decision. In your testimony, you discussed the fact that the Fed's monetary policy strategy is not well understood. So in what ways does the current communication policy, or keep the boss, or Congress, as you say in your testimony, well informed about the FOMC strategy?
Okay, so first of all, the draft legislation requires that the Federal Reserve have a clear strategy. That would already be a significant step forward. The legislation requires that the strategy should be identify a specific policy instrument, which could be the federal funds rate, it could be the repo offer rate, it might be something else over time. Identify a specific policy tool that it's going to use. Identify specific indicators. Now, as Jared said, and I agree with him on much of this, there were times in the past 5 years the unemployment rate was not a very sufficient indicator of the labor market. President Trump has emphasized that himself. That there are broader measures of unemployment. Jared has emphasized in his writings, we call it U6, that includes involuntary participation and people on the sidelines. So again, the Federal Reserve needs to have a clear strategy to explain to the public how it's responding to these indicators should be a small number, simple, clear indication. Again, I want to come back to the analogy about the patient, a child. I have a 9-year-old son, so this is, hits home for me. When the patient is sick and you go to a team of doctors, it's a difficult illness. You want a clear strategy, and you want the doctors have to consult with the patient's family. Everyone understands that. And we're talking here, as Ranking Member Moore said, we're talking, and Jared said, this affects all Americans. In the inner city, it affects small businesses, it affects large corporations, it affects people in other countries too. And so it's really critical here that this team of doctors on the FOMC has a clear strategy that the public, the Congress, financial markets, small business people, everyone can understand what that strategy is and the debate about it. I'm totally in favor of second guessing, by the way. I second guess the Fed myself. But if you don't have a clear strategy, then you can't debate about it. And it needs to be a public debate about what the Federal Reserve is doing.
Okay, well, let me ask you this. If the Fed takes a data-driven approach to monetary policy, as they have said they do, does it follow that allowing a clearer picture in predicting future policy direction will be beneficial to investors and the economy as a whole?
Yes, and again, during normal times, this may not be so complex. There may be periods when the Federal Reserve's policy rate is more or less normal and more or less stays within a narrow range over a period of time. What we're really talking about here with strategy is times when things are not normal. How's the Federal Reserve going to respond to that? I keep coming back here to contingency planning because, again, this is a good business principle for a nonprofit organization, too, to be thinking about what might go wrong and how will the Federal Reserve respond to that. I call it stress test for monetary policy. You're the boss. You should be asking the Federal Reserve, if we have a recession next year or 2 years from now or 5 years from now, what's the Fed's plans? How will it respond? Is it going to do more QE? Is it going to go to negative interest rates? These are critical to the whole American public and to the global economy. You're the boss. You have to get clear answers from the Federal Reserve on these issues.
Okay, Mr. Chairman, I yield my time back. Thank you.
The gentleman yields back. The chair recognizes the gentleman from Arkansas, Mr. Hill, for another 5 minutes.
Well, I've enjoyed this discussion. Of course, when you're with the deliberative body of second guessers, we can relate to your comment. We're experts at it. But one of the biggest impacts of the last 10 years of Federal Reserve policy is skewing benefits to the carry trade and to stock market investors and 401k investors and driving down interest rates on real estate to, I would assume, non-economic type levels. So there's been a lot of beneficiaries, and I agree that they really have not reached a lot of the working people because we've not seen wages growth or productivity growth. To Dr. Levy's comment about aggregate demand has not reacted to this 10 years of extraordinary stimulus, unseen in history. I mean, we have never seen lax monetary accommodation like we've seen now. I want to switch bills for a minute, Mr. Chairman, and talk a bit about the emergency lending proposal that's before us. And of course, the theme that we had both in the Choice Act and here is well-collateralized loans, not to insolvent entities, at a penalty interest rate and at a short-term duration. But this bill limits that to financial institutions supervised by the Fed, for example. I'd be curious in the panel's view, is that too narrow? Should 13.3 be limited only to commercial banking institutions or their holding companies, to be specific? I'll just like a view from all four of you. Dr. Plosser.
Oh, I think that is a bit of a difficult question. I do think that if you accept the notion, as the Fed has argued, is that there are a lot of non-banks, for example, who are involved in financial markets heavily, and so the so-called shadow banking system. How far do you extend this safety net? The problem is, I think, is if it is a safety, the Bagehot's rule for what Walter Bagehot rule for emergency lending was, as you said, lend freely at a penalty rate to solvent institutions. So now what we really are talking about do you want the Fed lending to insolvent institutions? And if so, what's the reason for that and what's the rationale for it? That is not what lender of last resort means. So I think we have to be careful about how we do structure this.
Well, the bill before us, though, is the borrower is affirming the borrower is not insolvent. So, I mean, the real question I have is, should 13.3 be extended to a non-banking entity?
I guess if I had to, given the way it's structured, I would say no. I don't think it's necessary.
Well, I just want to reiterate something that Dr. Bernstein said, which is most other central banks around the world do have broad authority in an emergency of what kinds of actions they can take. And it's not just about lender of last resort, and it's not just about too big to fail. What's the most important thing the central bank does is to keep a stable unit of account. We call it price stability. That's part of the Fed's mandate, okay? That's the single critical thing. And in a really severe shock, like we had in the Great Recession, or even going back to the Great Depression, we didn't have price stability in the Great Depression. Prices fell 25, 30%. So it's critical for the central bank to have enough tools so that when there is that kind of shock, that it can make sure that the price level comes back to a stable level. So I think there's a case for a Centennial Commission that would think carefully about what can we learn from history, what can we learn from other central banks, what can we learn from what worked and didn't work in the past recession, frankly. I think the Fed itself needs to do more lessons learned and come back to you. You're the boss. And help think through. We want to be prepared for the next crisis.
I agree.
I can be very brief.
Dr. Bernstein.
I can be very brief. Yeah, I think that's too restrictive. I think the Fed needs to be able to lend beyond financial service, may well need to be lend beyond financial services in emergency, because we just don't know the sector from which the next emergency will hail, much as Andy suggested. One quick thing. I encourage you to read what I wrote in my testimony about the penalty rate. I actually think the penalty rate in this proposal is less well thought through than the one in the Warren-Vitter proposal.
Thank you. Quickly, Dr. Levy.
No further comment.
Okay. Thank you very much. I yield back, Mr. Chairman.
Gentleman yields back. Chair recognizes the gentleman from Ohio, Mr. Davidson.
Thank you, Mr. Chairman. Thank you all for taking additional questions. As we talk about second guessing, I mean, I guess that's part of the whole point of this approval process, or validation that Congress agrees with what the Fed has done in this emergency lending authority. And Dr. Levy, I was just curious if you could comment on how the market might react to this period. If this becomes law, we know that it's sort of a conditional action. So it should be extraordinary. There are a lot of safeguards. It's a very high threshold that the Fed would go through to give approval. But once they do, how do you feel the market would react in this period before it's validated? And then what if they do, what if Congress does say, nah, we're not going to give our consent to that? Because it requires positive action. The asset would presumably be worth even less. How do you see the market reacting to that?
I can only have two comments in response to your question, and one is, what is the source and character of the crisis? And I would just note, the next crisis is likely to be unlike the prior one. And the second point I would make is the markets are going to move in response to the crisis. They're not going to wait around for the Fed and the Congress to respond. It'll, of course, respond to whatever the Fed does, but the markets are going to, they sense things. They're going to front run whatever they're going to be way out in front of you.
Well, they'll probably be indicators of what they expect Congress will react to.
Well, wait, let me qualify what I just said. The markets would take comfort if they perceived that you had thought through logical strategies in response to different types of crises. The markets would certainly take comfort in that. And also, I think communications about what you're going to do are critically important.
Yeah, so I thank you for that. And Dr. Levin, you commented a little bit about, the desired goal of something clear in advance. But here, it's retroactive. It's second-guessing something that has been done by the Fed. And so, Dr. Plosser, I'm curious your thoughts in terms of your 25 days passed, and the country can sense Congress isn't going to take action, isn't going to validate that. Is the time frame important? Is it 30 days? Is it 6 months? Is it how does it have to be paid back within 30 days? You know, how important is this to the market function?
So let me start by pointing out that one of the values of doing this is that you set out a process about if such and such happens, this is what we're going to do. These are the steps that are going to be followed. That's known in advance. All right? So markets will build into their own assessments. It's like a bankruptcy law. A bankruptcy law says if a firm goes insolvent, all debt is put into a holding pattern until you can sort through the assets and liabilities and figure out who gets paid. That's the law. So pricing of those assets in advance understands that step. Well, this is kind of the same idea. Here's what's going to happen. So by laying it out in advance, what the rules of the game are going to be, markets will price that effect well before the event actually happens. So that's going to make it less stressful than it might otherwise if this came as a surprise of some kind.
Yeah.
The second step, as you were getting to, is, well, how long should this holding period be on assets until, Congress decides? Well, again, I think that knowing this process in advance, and there's a lot in the bill about how Congress is expected to behave and how quickly they're supposed to sort of make a decision on this, I think all that's going to be filtered in, and the markets will make an assessment whether they think this is a good case for a rescue or not, and it's going to make the hurdle rate for the Secretary of Treasury to back the Fed in doing this. If he doesn't think he can, if it's not a good case and he's not going to be able to make the case to Congress, then it might not happen. But these rescues shouldn't be made easy. They're not, you don't want to encourage them and make them so easy that it just happens. So I think, yes, it's not perfect, but I think as long as you lay out the process, things will work as we think they should.
That's a good principle. Thank you. My time has expired.
Time has expired. The chair now recognizes for our final 5 minutes of questioning the gentleman from Indiana, Mr. Hollingsworth.
Best for last here. One of the things that fascinates me about economics generally, something you guys know far more about than I do, is just kind of its reflexive nature. And one of the things I really worry about, right, it's been a long time since I took Econ 101, but permanent income hypothesis, right, and the idea that we're working down somebody's curve in their preferences for consumption today versus saving for consumption later. But with the extended period of time with which we have undertaken these extraordinary measures, whether instead of working down that curve, we are bending that curve and permanently distorting their impression and their trade-offs between present and future, and it will be difficult for us to either work that curve again or bend that curve back. Such that monetary policy in the future might have meaningful impacts in the short run, at least. And I wonder kind of what your, Dr. Levy and Dr. Plosser's view on that is, and whether we are indeed beginning to permanently alter or misshape expectations for the future.
I think yours is a very valuable observation, and I would just bring out something that I'm very concerned about, and that is the Fed's policies, and it's had the federal funds rate below inflation now ever since 2008, and its massive balance sheet. People have come to believe that this is normal. And when I say people, households, businesses, savers, and financial markets. And that it potentially raises the costs of exiting and going back to normal. I would say so far the Fed has been lucky. And I would argue also that the Fed has been able to be leisurely in its exit because its policies to stimulate aggregate demand haven't worked. So I am very concerned about your point that we perceive current policy as normal.
Right.
It is absolutely not.
Dr. Plusser?
So I agree with what Dr. Levy just said. I think that the other thing is to recognize that during this period, there's been this huge conflict in public policy. There's the Fed trying to cut interest rates to zero to encourage people to spend today. Don't save,
Right.
spend. And then there's the pressure on banks to not lend unless you're really certain. So we're trying to, we're tugging at each other in ways that are it's confusing, I think, to the general public in terms of how they're supposed to respond to all this.
Right.
And you're telling the banks not to lend and build capital and telling the public, no, borrow all the money you can.
Yep.
And I think that tension is reflected in part what you're saying is, are we changing people's behavior about their preferences for borrowing, spending today versus spending tomorrow? And since we wiped out a whole bunch of wealth in the housing crisis, now what do households typically want to do?
Right.
They don't want to spend. They need to rebuild, rebuild their wealth.
Yep.
And so there are all these sort of conflicts that are going on that have, I think, been not very helpful at the bottom line.
And Dr. Levy, something you've talked about a few times, and I just wanted to bring back that point. Look, we talk about the philosophy behind whether the Fed should be involved in such activities that add such huge amounts to the Treasury, but also how those seemingly large amounts might pale in comparison to the potential losses should interest rates begin to rise and accelerate steadily. And so an old adage someone once told me was, be careful picking up pennies in front of a freight train. Even if you get it right a dozen times in a row, you don't want to be wrong once. And I think that your point about that several times is ringing true in my mind. And Dr. Levin, something I wanted to bring up and just talk a little bit about, you've pushed hard for transparency and pushed hard for a cogent strategy. And one of the things that's challenging about this, right, is knowing what success looks like, because everybody has a different vision of what success. What's full employment, right? 4.1% seems like full employment, but you look at U6, you look at wage growth, and maybe we don't really at full employment, all of these things. So to me, that harkens back to the need for a cogent strategy and transparency about how we will work these variables into something, right? Whether that's a Taylor rule, whether it's some discretion around a Taylor rule, just some understanding of these are the things we consider important, and these things moving in these directions will give us indications, but not a clearly defined end goal, if you will, since we will never be able to measure what successfully look like. Is that something that you would endorse kind of theoretically?
Yes, and just to underscore something I think Dr. Plotzer said earlier, the Fed's job is not fine-tuning the last tenth of a point on the unemployment rate or the inflation rate. Yeah. But it has a crucial job, and I think part of the balancing you're talking about is the risk management.
Yeah.
Again, like a team of doctors, to explain and say, we have a bunch of diagnostic tests, but they're a little bit hard to read here. This is an unusual case. So we're going to be keeping a close eye on the patient, and if this indicator goes up any further, we're going to have to take some action. Those are the sort of clear strategy I think your draft legislation is exactly looking for the Fed to start doing.
Perfect. Thank you, Mr. Chairman. I'll yield back.
Thank you. The chair yields back, and I'd like to thank all of our witnesses for your illuminating testimony here today. And Dr. Levin, appropriate that we leave the hearing with another reference to the excellent analogy of the patient and the family. And for laying the foundation for a strategy-based monetary policy that can help lift our economy. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for the response. And I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.